The Federal Reserve is trapped between rising inflation and a weakening economy, and the gold market is beginning to price in exactly what that means for investors holding gold, silver, or mining equities. The macro environment has shifted in ways that are not yet reflected in most portfolios. This video will walk through the Fed's current position, what the March sell-off in gold actually represented, the structural pressures on the US dollar, the valuation case for mining stocks, and where credible price targets now stand. The numbers are specific, the historical record is clear. What follows is an analysis of where things stand and what the data supports going forward. If you are not subscribed to this channel, the analysis in this video represents the kind of macro research that institutional investors pay significant fees to access. Subscribing costs nothing. Hit the button now and enable notifications so this content reaches you when it is published. The information here is detailed, and missing an update in this environment carries a real cost. The Federal Reserve has maintained a public posture of inflation vigilance while the underlying data points in a different direction. Nominal interest rates are one figure, real interest rates, nominal rates adjusted for actual inflation, are another, and it is real rates that determine gold's direction. That relationship is not a forecast. It is a documented pattern across 4 decades of market data. Inflation is rising across multiple categories. Oil prices are elevated, and based on current geopolitical conditions, are expected to remain so for an extended period. Food prices are climbing, driven in part by higher fertilizer costs and rising commodity input prices. Coffee prices have moved sharply higher. These are not isolated data points. They reflect a broad commodity price environment that feeds directly into consumer inflation measures, including the government's official calculations. The consequence is that real interest rates in 2026 are tracking materially lower than forecasters projected at the start of the year. Even if the Federal Reserve holds rates unchanged or raises them modestly, 25 to 50 basis points, those moves will not offset inflation running at the pace currently observed. Real rates will continue to fall, and that environment is historically associated with gold price appreciation. The additional pressure comes from fiscal policy. War expenditures are widening budget deficits. Political conditions ahead of midterm elections are creating strong incentives for economic stimulus, which would add further to government borrowing. Higher deficits pressure Treasury prices, push up long-term interest rates, and weaken the economy through elevated mortgage costs and reduced consumer spending. As the economy weakens and money supply expands to finance that deficit, inflation moves higher still. The Fed's ability to respond is constrained by the same inflation it is failing to contain. The result is a monetary policy environment that is structurally bullish for gold. Regardless of what the Fed communicates publicly, gold declined substantially during March 2026, recording its worst monthly performance since 2008. That decline was not driven by any deterioration in gold's fundamentals. It was driven by portfolio liquidation. Gold had gained approximately 8.3% during the first quarter of 2026, and 2025 had been the strongest year for gold prices since 1979. Investors who held large, profitable gold positions needed liquidity when the Iran conflict triggered broader asset sell-offs. Gold, being one of the few profitable positions in those portfolios, was sold to raise cash. The dollar index posted a modest gain of approximately 25 basis points for the week in question, closing just above 100. Within the broader structural context, that recovery is limited and does not reflect a change in the underlying pressures on the currency's global position. A marginally positive week for the dollar index is not inconsistent with a longer-term trend of dollar weakness driven by fiscal deterioration and shifting global reserve preferences. Gold and silver mining stocks delivered weekly returns significantly above those of the broader equity market. The GDX, which tracks senior gold mining companies, gained 14.5% on the week. The GDXJ, covering junior miners, gained 14.8%. Those figures include a decline on Thursday and reflect a trading week shortened to 4 sessions. Both figures compare with gains of between 1.65% and 3.2% across the major equity indexes. Despite those gains, both the GDX and GDXJ remain well below their peaks from late February. The gap between current mining stock prices and their prior highs exists even though the price of gold, the primary revenue driver for these companies, has moved substantially higher. That gap represents a valuation discrepancy that has not yet been resolved by the market. Oil prices are higher, and energy is a meaningful cost in mining operations. That is a genuine headwind for mining company margins. However, the scale of that headwind is not proportionate to the scale of the tailwind from higher gold and silver prices. When the commodity a company produces is worth significantly more, and the company's equity has not fully reflected that, the stock is, by standard valuation logic, trading at a discount to its intrinsic value based on current metal prices. The argument for mining equities is not speculative. It is grounded in the relationship between the price of the underlying metal and the earnings capacity of the companies that produce it. Gold prices have moved materially higher. Mining stocks have moved higher, but not proportionally. The gap between those two trajectories is the opportunity. Goldman Sachs maintained its 2026 year-end gold price target of $5,400 per ounce, based on the expectation that central banks will continue purchasing gold at elevated levels and that the Federal Reserve will cut benchmark interest rates by a cumulative 0.5 percentage points during a year. That target was set on specific assumptions about the inflation and rate environment. The inflation data now emerging, driven by higher oil prices, rising food costs, and broad commodity price increases, is running above the levels assumed in Goldman's baseline model. If inflation exceeds those assumptions, real interest rates fall further than the model projected. When real rates fall further than projected, the historical relationship between real rates and gold prices supports a price outcome above the published target. The $5,400 figure may, under the current trajectory, prove to be a conservative estimate. The nearer-term case for gold returning above $5,000 by the end of April is based on the same reasoning applied over a shorter horizon. Gold approached $4,800 during the first week of April. The fundamental drivers have not changed between that high and the Thursday close of $4,676. Central bank demand remains elevated, real rates are falling, dollar pressure is building. The March sell-off, which drove prices to approximately $4,100, is now widely understood as a liquidity event rather than a fundamental repricing. World Gold Council research covering the period from 1973 forward documents that gold has delivered strong returns during stagflationary periods, economic environments combining slowing growth with rising inflation. The reasoning is direct. Gold carries no counterparty risk and benefits from the same inflation expectations that reduce the real value of fixed income assets and erode equity multiples. The current environment, a weakening economy alongside rising inflation, fits the definition of stagflation. The historical record offers a consistent reference point for how gold has performed in comparable periods. Goldman's $5,400 target reflects the consensus view. The inflation trajectory now unfolding and the fiscal and geopolitical pressures on the dollar suggest the risks to that estimate are weighted to the upside. The analysis in this video rests on documented data, historical relationships, and publicly stated forecasts from credible institutional sources. Gold is up approximately 8.3% year-to-date through the first quarter of 2026, despite a significant March decline. The major equity indexes remain negative on a year-to-date basis. Real interest rates are falling as inflation rises faster than nominal rates adjust. Central bank gold demand remains at elevated levels. Mining stocks are trading at a discount to the value implied by current metal prices. The dollar faces structural pressure from widening fiscal deficits and shifting global reserve allocation patterns. These are not isolated observations. They are interconnected elements of a macro environment that has historically been associated with gold price appreciation. Investors who have reviewed this analysis and found it consistent with their own research should consider whether their current portfolio positioning reflects those conditions. If this video provided useful context for that assessment, subscribing to this channel ensures continued access to this level of analysis as conditions develop. Comments are open. Use them to share where your current positioning stands and what questions remain. This pattern selling a high-performing asset not because its thesis has changed, but because it is the most available source of funds, is well documented in institutional portfolio behavior. It produces temporary price dislocations that do not reflect the underlying value of the asset. The March sell-off in gold was one such dislocation. The reversal came quickly. During the first week of April, gold moved from approximately $4,100 on Monday to nearly $4,800 by midweek, a move of roughly 17% over 4 trading days. The weekly close came in at $4,676, representing a 5.8% gain on the week, with a pullback on Thursday attributed to President Trump's speech, which indicated the conflict would continue and potentially escalate. Silver closed the week at $72.90, up 7.2%, ending back above the $70 level. For context, those weekly returns compare with gains of approximately 2.4% in the S&P 500, 3.2% in the Nasdaq, 1.65% in the Dow Jones Industrial Average, and 2% in the Russell 2000, all of which remain negative on a year-to-date basis, while gold retains a positive return for the year despite the March decline. The setup for April reflects the scale of the March dislocation. When an asset declines for liquidity-driven rather than fundamental reasons, and when the macro conditions supporting that asset remain intact and are in fact strengthening, the reversal tends to be proportional to the prior dislocation. The argument that April could represent gold's strongest monthly performance since 1980 rests on that relationship between the magnitude of the unjustified decline and the force of the subsequent correction. The U.S. dollar's reserve currency status rests on a combination of institutional arrangements, mutual economic benefit, and confidence in American fiscal and monetary management. Each of those pillars is under pressure. Budget deficits are widening. War expenditures are increasing government borrowing at a pace that adds to already elevated debt levels. The political environment favors additional spending ahead of midterm elections, not fiscal consolidation. The Federal Reserve's capacity to tighten meaningfully without triggering a recession is limited. The cumulative effect of these pressures is downward on the dollar's long-term purchasing power, and the global investor community is aware of that. The geopolitical dimension adds a separate and significant source of pressure: the manner in which the United States has engaged militarily in the Iran conflict, and particularly the posture of withdrawing from post-conflict responsibilities while leaving allied nations to manage the consequences in the Strait of Hormuz, has created friction with countries that have historically supported dollar reserve status by financing U.S. trade and budget deficits through treasury purchases. When those countries reassess the mutual benefit of that arrangement, the incentive to hold dollars in U.S. treasuries as reserve assets diminishes. The trend toward de-dollarization. Reducing reliance on the U.S. dollar for international trade settlement and reserve holdings was already in progress before the current conflict. The geopolitical developments of 2025 and 2026 have added momentum to that trend. Central banks that reduce dollar holdings allocate that capital elsewhere, and a significant portion of that reallocation has historically gone to gold, which carries no counterparty risk and cannot be subject to sanctions or asset freezes. Central bank gold purchases have run at elevated levels for consecutive years, and the conditions driving those purchases have not abated.